And, a big thanks to our hosts as well. Take just a minute to say Marky Mark and 8 Ball, Mr. Shine himself, gosh, all the other guys who I haven't met, as a matter of fact, but with a name like, was it Big Mike Baghdadi? God, I want to meet that guy. He sounds incredible. I don't know anything about him, right? And yeah, Panera on the corner, because everybody always asks about that sandwich. I don't know why. Um, so that gives you guys an idea of a little bit about the type of trader I am and what I can appreciate, which is having a lot of screen real estate. And we're actually going to talk a little bit about that, just very briefly. The aspect of volume weighted average price, that it takes something that is otherwise very quantitative and it makes it visual. And we as humans, we're not robots. I mean, most of us, right? We're not all as consistent as Melnick. We can't all be robots. We like having a very clear visual impact with the analysis. I guess we want high visual efficacy. I'm struggling for the right phrase here, but it's easiest when we can make things sort of, what's the phrase I'm looking for here? Most easily digestible to the non-quantitative trader is, I guess, what I'm getting at. We want to make this accessible to retail and developing traders. So that's one of the coolest parts about this. So, all right, now that we got things set up, and 8 Ball, would you like me to wait any longer, or you think we got most people back in?
No, give it a little time.
Sure, no worries. I can chatter for a few minutes. I will also tell you guys a funny little thing about this trading setup that I'm displaying right here. That is a 42-inch TV that I pulled out of my living room, totally cut off my cable access, realizing that I don't watch TV at all anyway, and just mounted in the corner of my room. So all of the monitors have kind of magnetically pulled into the office, and people make fun of me pretty routinely for it, but hey man, you gotta do what you gotta do. And when you are working from home, oh, there we go. Things are getting reorganized here on the screen. We got the whiteboard up. Cool.
You're doing this, correct?
No, I'm not, as a matter of fact. It's just going crazy. I thought you were doing it. That's right. I didn't say anything.
No.
All right, no worries.
No.
Is the screen share still up? No. Okay, one second. I'll pull that back up. Like I said, thank you guys for being patient. Oh, gotcha, West Side. I get it. So it gives everyone access to it. I get you. Strange. All right, well, I will share the screen once more. Okay. Here we go. I'll tell you guys another little tidbit, because I did say that I'm working with a fund based in Boca Raton, Florida, but I live in Cincinnati, Ohio, which is, you could say, markedly less glamorous, but beautiful in a different way. So I'll show you guys a picture of where I live. Doesn't that look nice? That's Cincinnati, Ohio. Yeah, no, it's definitely not Cincinnati, Ohio. That's Monaco, for anyone who's wondering. And I do keep that picture as kind of a reminder of where I'd like to end up one day. Um, and yeah, if the Bengals played in that stadium, I bet they'd be a lot better, don't you think? Hot and humid Cincy. Where is not hot and humid right now? I came up and actually it was last September when I first met the Bear, your lovely tech support back office guy, in the muggiest weather of all time, New York City, September. It was rough, what can I say? I'm going to be pulling up some charts here just so we can get some backdrop, other than beautiful Monaco, which I like to pass off as my city. You can run through the disclaimer and then get along the way. So I'll tell you what, since my secret's out that I'm going to be talking about volume weighted average price, why don't you guys in chat feel free to type either yes or no or Y or N or something. Are you familiar with or have you heard of volume weighted average price before? And this can be, super basic. It doesn't have to be, you're familiar with it on a working, but, I just want to get an idea of, yeah, it seems about 50-50, and that's perfectly fine. What my plan was for the day was specifically to go through the theory behind volume weighted average price and how it's transformed the way that I look at the market. So we can look at some more in-depth, setup criteria, risk management a little down the road if you guys are interested. But I felt like starting at ground level would be best. And I'll tell you the truth, when I first learned about this, it was not something that I actually really understood. I just saw it, it looked nice, and I was committed to learning more about it. The more and more that I used it, oh gosh, you have no idea how deep the rabbit hole goes. All right, so I'm going to get on with the disclaimer here. And I know that 8-Ball has already given me quite a nice introduction, but I'll just say this. And I know you guys know this, but everything I say here today is educational, illustrative in nature. Nothing should be interpreted as a recommendation to buy or sell any security whatsoever. This is Shine's room. I know you guys are all big boys who understand that technical analysis is an uncertain science. It involves risk, yada, yada, yada. If there's some way you've gotten to this point in your trading career and you're unfamiliar with this speech, seriously, reconsider your profession. I'm sure you guys understand that. So, I will not give investment advice. That's the golden phrase, isn't it? Yeah, you've heard of it. Nobody ever listens, right? It's like an airline safety speech. And for those of you who didn't catch this one of the first 8 times that we said it, my name is Zach Hurwitz. I'm an independent trader and technical trading consultant. I live in Cincinnati, Ohio, and I'm 26 years old. I've been peripherally involved with the market since 1998. Long time, I know. And I'm dead freaking serious about this. I have the trade reports to prove it. My first trade was I returned the iMac that I got for Christmas in 1998. I bought $1,200 worth of Apple stock with it, which I still own. So yeah, Brooks, doesn't that make up for living in Cincinnati? So I always tell people that trading tidbit, partially because it sounds great, and I wish I was that guy, that kind of trader. But part of it was naivete, just not knowing enough to be scared enough to sell somewhere along the way. And it's interesting that that was my very first trade. I don't think I'm ever going to top that one. Yeah, exactly. Hermosa Beach, California. Ooh. So, when 8-Ball asked if I'd like to speak to the room, I really jumped at the opportunity. I am always down to connect with other bright, focused traders like those in Shine's room. So, like I said, thank you very much to our hosts as well. I really like how focused everyone in the room is and how tight-knit the crew seems to be. That's admirable. It's very cool. And of course, I'm going to be speaking about VWAP, volume weighted average price, and more broadly, like I said, how this completely changed the way I look at the market. So a heads up real quickly. I want all the simple moving average traders. Pepe, I'm looking at you, bro. I want you to listen up. I'm probably going to offend you. I'm going to challenge you today. It's going to be a good talk when the speaker says that he's just going to straight up offend a good portion of the audience, like right off the bat. And I'm kidding, of course. I have respect for other elements of technical analysis, but something we're going to be doing is comparing volume-weighted average price to simple moving averages and exponential moving averages. And something else I'm going to tell you really briefly is this is not going to be a super visual presentation. So I want you guys to do a favor for me, okay? Take your, right arm and just straight up in the air, just stick it straight up, and then take your left arm and straight up in the air. And okay, this is called stretching. I want you guys to relax a little bit. This is a public service announcement for the coalition on, not having circulatory issues later in life. We as traders sometimes forget that this is the lunch hour. You can wind down a little bit. All I want you guys to do is have me on in the background, listen to the stories, so to speak, stories, plural, the story of volume weighted average price, And if it seems like something you guys are interested in, of course, we can go into technical setups, actual examples. We can look intraday. And of course, I've left some time at the end for questions. So, and I do apologize if I miss any questions while I'm, chattering away. Go ahead and just keep typing them. Spam the questions at me. Eventually, it will get through me. Or you can just wait until the end, of course. So, volume weighted average price. And I split it up like that because that's really true, the best way to think about it. You're already probably familiar with the second half, the average price aspect. That really just means it's a moving average. Pretty simple. The volume weighted aspect, however, is where all the nuance and sort of difficulty comes in for most people who have never considered a variable weighting to their moving average lines. So like I said, this is a participation weighted moving average where trade volume is proxying for participation. The higher the volume, the more the impact on our moving average line. It's time frame independent, so it's going to be consistent on a 5-minute, a 15-minute, a 60-minute. It's going to be the same. This eliminates a huge problem. And yeah, sorry, the screen share is stagnant. I'll tell you what, I will throw some charts up just so you guys know it's still live. Here we go. Let's find the cues were a good example today. There we go, so we can watch the market while I babble away. I was just saying it's time frame independent, so that consistency eliminates a huge problem in traditional technical analysis. That your time frame or your indicator settings have to be correct, and you have to shift them when you shift time frames. And I know there are some that are consistent across almost all time frames. I've heard an 8-21 EMA cross strategy very frequently. 20 and 50, 13-31. A lot of these more familiar, more traditional, moving average setups that might have to be tweaked either according to the stock you're trading or the time frame that you're looking at. So I like it because volume weighted average price is a simple but dynamic method of categorically ensuring that you're finding the fairest average price available. And we'll get into the less fair average prices that are available to you as a trader. And I know this sounds a little clunky and a little strange, but when we see the examples, it'll make more sense. I describe this to people early on as it's almost as if you had a junior trader on your desk assigned to drive all the moving average lines according to how important or how heavy in participation the trade is that's supposed to impact that moving average line. But at its core, and this is the sweetest part about it, the VWAP is just math that describes complex human behavior and mean reversion ahead of time. So I'm going to say that just once again. The VWAP is just a piece of math that describes complex human behavior and mean reversion. And a little down the road in the speech, we'll look at how you would have to develop this on your own. And you'll see that there really aren't that many good alternatives for finding a semi-dynamic or dynamically weighted moving average line. So of course, what's it used for? A lot of people obviously are like, well, this is great, but why am I looking at this? Broadly speaking, of course, it can give you proper market bias. It's a very simple, straightforward binary indicator for market direction. Who doesn't like that? Right? I mean, this sounds like a perfect stoplight, red light, green light. But of course, as we all understand, there's plenty of nuance to go along with it. And there are plenty of opportunities for the market to blip ever so slightly below these levels, something that we actually saw on the cues here about half an hour ago, where it's trying to probe ever so slightly below our dynamic pivot line to freak out the traders who are trying to play, I call them tight stop Tonys, the guys who put their stop 2 cents away. And I'm not referring to 8-ball here. He uses about 8 cents, 10 cents. That makes sense. No pun intended, of course. The guys who are worried about, oh, well, this violated my level by a penny. I gotta be out. They're not giving appropriate risk tolerance, I think. So just to clarify, I'm not talking a little bit of smack about 8-Ball, like, hey, thanks for giving me mic rights. By the way, I totally disagree with your trading. No, I'm just kidding. So just like a normal indicator, this takes quantitative data and translates it to make it easy and visual. As a non-quantitative trader, as I was saying before, visual efficacy is a huge consideration. That's why I have so many friggin' screens. A big part of my job is using, and I'm not making this up, this sounds kind of silly, but using peripheral vision to detect when on those multiple grids of 20 some stocks per screen, something is moving close to one of the volume weighted average price center lines. That lets me know to go on high alert and try and discern what is going on with that trade, because these are my action points. And this leads me to the latter 2 points about what it can be used for. It is low risk, continuation of trend entries. It's a trade initiator. And similarly, it's also a high probability targeter for exits, either stop out exits, saying something like, I'm going to wait for a 5-minute bar to close below the volume weighted average price. And that will tell me, and I'm making this up, guys. This is obviously not a strategy. This is just something I pulled out of the top of my head. Or limit order profit targets. Let's say you are a counter trend trader and you're playing mean reversion, particularly on a day like this. Phenomenal day to do this, of course. You get multiple opportunities to cover your shorts back at the volume weighted average price, knowing full well that it may continue and just traverse way down to the complete other side of the chart. But at the very least, you're targeting a high probability reversion point. And I know 8-Ball would back me up on this. It's all about the bread and butter, man. It's the trades you see that set up safely, that you can take with proper risk management and count on. I mean, you can count on them. You've seen these trades 100 times. The risk isn't too much because you're not a noob. You're not trading, way too much of, Google. I love when someone calls me freaking out and says, what do? I got 1,500 short Goog. And I'm like, well, you could be making money and that would probably still be an issue for you. Just out of, consolidation of capital. You got to spread out. You got to use risk management first and foremost. I'm sorry, I'm going a little off topic, but just want to clarify. The benefit of getting these low risk entries or high probability reversion targets, like I said, is you take them as bread and butter trades. You're not banking on it with thousands of shares. You're comfortable with a few hundred or maybe 1,000 or 2,000, whatever your sizing says is appropriate, to get involved, just to participate. And hey, isn't this fitting, right? We're talking about a participatory algorithm. We're talking about just participating. Hopefully this will all wrap up in a nice, neat circular package towards the end, right? All right, let's see here. So really, when I was writing this, what I want you guys to walk away from this with, 3 things: a mathematical, an intuitive, and maybe an anecdotal or like visceral understanding of why vol-weighted average price is so significant in the markets that we trade every day. And I stand by this, and I have challenged many people, and I'm looking for you guys. I'm looking at you, 8-Ball, Mark, Pepe, Dave, anybody. I want someone to find a piece of technical analysis that has as much behind it to support it, like I said, mathematically, intuitively, even anecdotally. And we'll see that with some evidence, right? I want you guys to understand why vol-weighted average price is so important. So mathematically, what we're going to do is we're going to look at its definition, see that volume weighting the moving average improves your accuracy and objectiveness of our average price analysis. From an intuitive basis, we're going to see that there's a feedback loop with strong or weak stocks that we've probably all experienced before. Has anyone ever seen a unidirectional market? I am sure we've all seen unidirectional markets. Let's rewind, 24 hours. That's more behavioral, I think, than order flow. Because I feel like order flow has impulsive and then corrective waves. Behavioral is like, I'm going to botch this quote, but turn the machines back on, sell, Mortimer, sell, something of that. I mean, it's a little before my time. That was in the 80s, right? Somebody, Trading Places. I know there are gurus on these quotes in this room. Um, but speaking of unidirectional markets, it feels like we need to have an understanding of the behavioral side of things just as much as we need to have an understanding of the mathematics behind it. And then again, anecdotally, we're going to look at it not only as an institutional benchmark, so knowing that a broker's fills are going to be judged by his clients against the volume weighted average price, most likely, because it is a fair and commonly known and easy to derive benchmark. This is obviously monitored by the big players. This is obviously going to be monitored by the big players. And hey, a great point from the bear, and thank you for mentioning this. I would not have thought about this. It will be available later. So for those of you who are tuning in just now, don't worry. You really haven't missed much. I showed a fake picture of Cincinnati, which I tried to pass off as my lovely city. Nobody believed me. And then I spent about 15 minutes telling people why I think this is so freaking important. And so, yeah, we're just getting to the point where on my speech it says why VWAP is so important. And this really is the golden nugget of the speech. If there's one thing I want you guys to take from this, and this is where the challenge comes in, to Pepe, to Mark, to 8-Ball, and good-natured challenge. You guys know I'm not showing up to talk smack. I want to find other pieces of TA, technical analysis, that have this kind of support. Okay, here's the golden nugget. Most indicators are a function of price. Rarely is price a function of the indicators. And that sounds pretty obvious. I mean, that's not groundbreaking knowledge here, right? That indicators are, by and large, going to be lagging. And that makes sense because the input is some measure of price action. Okay, cool. But price actually reacts to this indicator, meaning you've got advanced information about the likely character of the market. I got to be straightforward with you guys. Full disclosure, it doesn't react to the VWAP. There is no one driving the market who then declares, oh, well, VWAP is here, I'm going to push the market and therefore control it. As we all know, that's victimizing talk, believing there's guys in smoke-filled rooms who are driving the market. But again, think about what I said before. It's behavioral. It's collective behavioral. And that's why what we're going to be doing with the volume-weighted, and this is the key, average price, right? We are aggregating all the prices and then all of the volumes traded at those prices. And we're going to sum them divided by total volume. We're going to get some sort of measure of what the actual weighted price is compared to just an arithmetic. Is that how to put it? Yeah. Arithmetic mean or a geometric mean, right? Or exponential mean. Just out of curiosity, Chris, and feel free to clarify, what's the rationale for that? What are you referring to? And so, in talking about reacting to this, I guess what I'm saying though is because it takes into account order flow in a way that other pieces of technical analysis may not, this is radically different than anything you've probably ever looked at in terms of an indicator. And when that clicked for me, that was the moment when I feel like I grew into a legitimate trader. When it dawned on me that some indicators were really, truly better than others. Oh, for the indicator driving price. Okay, Chris. Chris is asking, what's the rationale for most times price drives indicators? Well, of course, that makes sense because the indicator has to wait for some input of, no new high in the last 5 minutes, or, the volume is higher on this bar than on previous bars. Therefore, the RSI will increase to show more participation as price is increasing, or something of that nature. Because they are all lagging indicators. And what I'm going to get at with volume weighted average price, because again, it is just an indicator, quote unquote. But there's so much power behind this simple calculation that more often than not, and as I said, because institutions benchmark their quality of fill, and clients of institutions benchmark their quality of fill, I should say, against volume weighted average price, it becomes this self-fulfilling prophecy of sorts. Now, it's not only on the behavioral side, it's also on the mathematical side. And this is what we're going to get into. Indulge me for just a second. I'm going to go off on a tangent about sharks. No joke, I really am. And then we're going to get back into, and don't worry, this all fits together. I'm not just going off on a random tangent. So why does this work? And of course, my answer is sharks. I'm sure everyone in the room is like, oh my God, who are we listening to? How crazy is this guy that he's talking about fish right now? Well, of course, it's a metaphor. When I started in this industry, it was filled with the old guard. You know, the guys who looked like they walked out of Glengarry Glen Ross, jaded, just burned out, barking about like, hey kid, if you think you want to swim with the sharks, you gotta be a shark. You know, they throw a drink back. It's a tough racket, right? Those guys. It's always been a personal goal of mine to try and. No, that wasn't an 8-ball voice, but that's really funny. That was not an 8-ball voice. Got to clarify. It's always been a personal goal of mine to avoid trying to think like a shark, though. Just simply because that to me feels like I'm late in the trend to try and fit into the power suit Wall Street mentality. Like I said, I'm a 26-year-old who works from home in Cincinnati, Ohio. Whoa. Can you get more different from, Charlie Sheen, right? Uh, he could have been somebody, 8-ball. It's so funny. But, you know what, I guess what I'm saying is I don't want to feel like I'm a guppy, though. right? Some flailing newbie retail trader excited about a system one day and then another the next and just hopping around everywhere. But similarly, I don't think it's necessary to be a shark. There's somewhere in that spectrum that I think fits best for myself and probably for a lot of the other traders here. I think about it like a barracuda, right? Because that's kind of in the middle. They're not defenseless, but they're not sharks either. And like I said, my whole point is just that there's some middle ground between newbie and old shark status. That middle ground is called reality, and it's where most of us spend our time, right? What the guy should have said is, and this is the realistic approach, if you want to swim with the sharks, right? Okay, now maybe it's a little late ball. Pay attention to how the sharks swim and then swim accordingly. And the distinction there is you're not trying to be someone you're not. You're not swinging 3,000 shares before you're ready, paying attention to a hot tip on CNBC or some other crazy shit that we hear. I think it's really just about observing and exploiting rather than emulating. So let's talk about sharks for a second, right? The common misconception is that these big guys don't really want to talk about what they're doing that works. They want to keep it secret. Well, let's crack that code. Let's just bust it wide open. Let's build the most common algorithm there is in the institutional world, a participatory algorithm, right here in Shine's room at noon on a Wednesday, right? No code, a little bit of math, mostly just our brains. Okay? If we were sharks, so I want everyone to put your fins on for a second, we'd probably be buying strong stocks and selling weak stocks. Okay, this is not groundbreaking stuff, right? Broadly speaking, that is a fair assessment of what winning traders do. So our goal here is, of course, to build a thematic variable, something to describe whether a stock is strong or weak. Sure, that's going to be a little mathy. It's got to, we're talking variables here, of course, but it has to also make sense from a trader's standpoint. And that's why I'm not, trying to code something into a text pad file for you guys. We're not using Excel. We're not back testing anything. We're just going to talk it out. It's going to have to make sense from a trader's standpoint, right? Let's see. Where was I? I'm sorry. Just meaning we're not quantitative traders. We're going to be just using our brains. We're not going to be optimizing curve fitting. This is just for the purposes of discussion. And obviously what we're trying to do is build really simple logic rules for either buying or selling without knowing the price ahead of time. Okay? This is that shark algo we're talking about, the technical buy programs that sometimes hit the market that just buy everything in sight and at a random time. When we're up lightly on the day and boom, everything hits and we blast off. A plus trigger, right? That's considered a participatory algorithm, right? It's not initiating that trade. It's just hopping on board once it has positive internals and whatever its metrics are satisfied to be a buy. Right? In Sharkland, since you never know the price ahead of time, you pretty much have to code something that would apply to any stock in any situation. Okay? So our starting point, of course, is what about a simple moving average? Now, I know if I said, is everyone familiar with simple moving averages? Everybody would be like, yeah, dude, we got it. Right? Because every trader, I think that's trading 101, you learn about these linear representations of trend. They're a little bit behind the market, of course, because they're taking into account only historical data. Right? We can't know what's about to happen. Interesting, Brooks. I will take a look at that in just a second, by the way. But we're really just trying to find, I guess, ahead of time, some easy measure of, are we going to be above this SMA? Is this a fast enough SMA or a slow enough SMA? The duration or period, what is it? Periodicity, I guess is the right word. Is that the right word? You guys tell me. The period of moving average that you choose can have a huge impact on the efficacy of your strategy, right? If you choose too slow of a moving average, it's going to be kind of going sideways, and so it will never give you fast enough signals. If you use a really fast moving average, well, that's not going to work either because it's just going to jitter all over the place. Give me 1 second, guys. I have my trading platform up in the background, and as it fires off alerts and things, I always got to check in on it, make sure nothing horrible is happening. Here we go. And Goldman Who throwing out, I prefer flow and triggers, combine it. And yeah, absolutely, man. That is what we're going to get to. What we're kind of building is a semi-dynamic pivot. So if you think about it like a pivot point, but it looks like a moving average, well, boom, there's volume weighted average price in a nutshell. So we're kind of jumping around, but like I was just saying, simple moving averages are, just simple average of price over a fixed look back in time. There are also exponential or, more reactive, faster reacting moving averages. These can sometimes be a little too fast, though. They might follow price too closely and not give you quality signals. They give you too many trade initiation signals. Okay, so now we're getting into kind of a Goldilocks scenario. Traders are really easily frustrated by this, that some markets you need really fast moving averages, some markets you need really slow moving averages, and some markets, no moving average is going to help you because they're stuck in chop. Well, this is where something like taking into account an additional dimension of price action is going to help you get a clearer picture of true average price. So like I said, VWAP is a summation of all of the prices for the day times all of the volume transacted at those specific prices. So it's like if you had a bunch of apples from your apple harvest and you wanted to know the average weight of an apple. So you would, throw all the apples into bins of, let's say, 5 at a time. And you would weigh all the apples. And then you would divide all of that by the number of apples in each bin to give you a per apple rating. Okay? Now, this is a dumb analogy and kind of, out there, but I think you guys see what I'm saying. What if you weighed 15 apples at a time and divided by 15 per, right? I mean, that would produce the same result. They're the same apples, whether you weigh them in groups of 5, 15, 30, 60. I think you guys can see where I'm going with this. Volume weighted average price is time frame independent. And so that is a huge relief because man, oh man, I've had a hard time with simple moving averages before. When I was a developing trader, early on in my career, that really got to me that I had to keep adjusting my moving averages until I found something that worked. And when I switched to a new stock, for example, imagine trading low beta stocks with a moving average setup and then taking that same setup and going to high beta stocks. Now, I'm not accusing that all simple moving average traders have to use the same. No. They can change it up and they use that nuance to their favor, right? They want to find what idiosyncratically works for that stock. But that's a little too much hassle for me. I'm young, I'm 26, I'm lazy, I'm from generation entitlement. So of course, there's got to be a better way, right? There's got to be a better way. So when we talk about this, and yes, I'm sorry, VWAP is total dollars divided by volume. Roughly speaking, yeah, it's price divided by the volume transacted at that price. But the actual notation would be a sigma summation of price times volume for each instance. So there can be, thousands of terms in that numerator, and then you divide all that by total volume for the day. You've explained what VWAP is in several ways, Doug is saying. What you haven't explained is how you use it to determine buy and sell points. Absolutely, and I'm sorry, this is kind of a long-winded explanation, but I think you guys will get sort of why I've walked through it this heavy-handedly. And also for the guys who are new to volume-weighted average price or are new to moving average trading, I really want them to have an appreciation for what could be, the road of moving average trading and what this adapts from that and what it segues away from. So hang with me for a little bit, and then we'll start talking about some of the specific, because I do have specific setups for you guys that we can take a look at. And hey, thank you, Westside. I appreciate it, man. I was terrified that you guys were going to be like, boo, get this guy off the air. So, of course, that's why I started making fun of 8-Ball. I figure, when in doubt, pander to the crowd by making fun of the host. I feel like that's really a safe thing to do. So, and briefly speaking, Doug, just to answer your question, to satiate your desire to get that question out, what's the point of using it? It will keep you on the right side of the trade more often than not. That is the simple answer. It will also provide you with low risk entries in trending markets. And when you think about what you try and do as a trader, and I'm just taking a guess, obviously don't know you, I don't know your style of trading, I'm saying the royal you, what we all as traders try and look for are low risk participatory entries in trending stocks, right? I mean, I feel like that's what everyone wants, is a safe, easy trade in a stock that is just freaking blasting off, that you buy on a pullback with a reasonable amount of shares, and it all goes well. I mean, that is perfect. If only every trade were just like that. But sometimes you take breakout triggers, like what Melnick calls out all the time. And these are a different style of trade, but it's important to notice that they're no less, effective. It's just a different style of risk. And one thing I really want to applaud specifically Mark and 8 Ball on, because I've seen them do it time and time again, is they manage risk like beasts. Something goes against them and they're done with it. Who cares? I love when 8 Ball says that. Who cares? Whatever. I move on, right? On to the next one. And that's a great approach, because something you'll begin to understand looking at volume weighted average price is that it standardizes market behavior. Since you're going to be looking at the same thing on every stock, every futures contract, all ETFs, commodities, bonds, whatever, you start to build kind of a repertoire of, I've seen this before. Or, oh yeah, the last time this happened to me, right? Build that nuanced repertoire, right? And yeah, there's a boo button in the bottom right of your keyboard. Yeah, 8 Ball hit that earlier. I think he was just like, changed my mind about the Zach kid. Let's just crash the room. I'm just messing with you. 8 Ball's a good sport, isn't he? You can see 8 Ball's typing. Oh no. Keep throwing me under the bus, Zach. Oh, you're a good sport, man. You're a good sport. Okay, so back to volume weighting and what this can provide for you. So I want you to take a moment and appreciate, you've probably all experienced this type of significance weighting before in your everyday life. So I want you to think back to high school. I bet that many of you, like me, would have had slightly higher grade point averages if only the A's that we got in gym class could have offset all the B's and C's that we got in chemistry and art history, right? But rightly so, unfortunately, these tough, meaningful classes like chemistry, count for a full credit hour towards your GPA. Gym class is a quarter hour or half credit, right, towards your GPA. That's because your high school probably used a weighted GPA instead of just throwing all your classes in there and letting them evenly aggregate. So by weighting the GPA, just like weighting a moving average instead of leaving it to a straight up mathematical calculation, it more fairly and therefore accurately values your class time in high school, just as it would values average price more accurately than simply looking at a near-term moving average would. So, like I said, taking this back to trading, the comparison is, of course, the participation in trading, the volume, is just like the level of significance, so to speak, of the classes in high school. The more important ones are like the heavy volume trade. And I know I'm not, again, this is not groundbreaking. Heavy volume trade is probably more important than low volume trade. I think we can all sort of agree. Now, granted, price is price, and whether it's on high volume or low volume doesn't matter, right? It's still price, and that is the chief metric. But because of what we're doing, we're looking at this secondary metric, volume, right? And actually adding a tertiary characteristic. God, we're getting deep into the big words already. But we're adding this character of how much volume and at what price. And then how far away from that average price are we? All these different colors that we're throwing onto the market. Wow, well, that really gives us a totally different way of approaching the market instead of looking at it, just from the same, oh, wow. Okay, I get this now. Well, I hope you guys are having this kind of epiphany where it clicks for you, where you realize that there's another dimension of trading that most people don't really analyze, which is volume. They either say, oh, it's increasing or decreasing. Oh, it's high volume or low volume. They never really take it into account when calculating the inputs for their technical analysis. So that's sort of the transformative element going on here. Dan K asks, can a market profile with point of control and value high-low act as a supplement to the VWAP? That's a great question, and yes, they are very much related. I'm actually going to throw one of those on there so everyone can see what you're talking about. And I don't actually have market profile, but I do have volume profile. So this gives you the same volume as a function of price, meaning at each little price bin, so within these, 2 cents or this 1 cent increment here on the Qs, we had a high volume node of trade, meaning at this point, more volume was transacted than a lot of the other ones. And as I'm sure you guys can see from tilting your head 90 degrees to the right, looking at this histogram here on the right side, it's just like a somewhat standard distribution, a normally distributed market. That is obviously very common. And anyone who's familiar with market profile or auction theory or anything that goes along with this will obviously understand sort of what I'm talking about. What this is doing is taking the internals of VWAP and spitting them out on the side in the form of a histogram. So absolutely, this would be a great supplement. And I'll be honest, I normally do have that on my charts. I took all sorts of stuff off the charts just because I was afraid that I was going to put something really complicated up and people are going to be like, wow, is that VWAP? And I'm like, no, that's something totally else. Ah, crap. It's my greatest fear is that I'd mislead you. So how can we use VWAP in trading? What are the various parameters? I know everyone's like, yeah, just shut up and get on with it. All right, I will move speedily through the rest of my semantics, and then we'll get on to a few brief setups, and then I'll turn it back over to the boys so they can get on with the 1 and 1:15 afternoon psychological analysis, which, by the way, little side note, that's my favorite part of the day. I really do like that, and I like that they can appeal to that kind of midday slowdown, but they still make use of the downtime. So that's pretty cool. Thumbs up, guys. So okay, we talked about this. The volume weighted average price is really just a special moving average. Okay, it looks like a line, but carries much more significance, and it's different in that it's dynamic. It adjusts to account for participation, where other moving averages don't, and it's holistic, meaning it starts at 9:30 a.m. or in pre-market if you have it selected, and then traverses throughout the entirety of the trading day. It does not reset until it comes to the start of a new day. And so that's a huge distinction from a normal moving average, which is periodic, right? We talked with, periodicity, right? The word that I may have made up. It may be correct. I don't know. The problem I have with moving averages is they're either going to be such a small period of time that it doesn't take into account something that might have happened like an hour ago, which is still very relevant to the market that we're trading as short-term, mostly day traders. I think it's important to note that if you were to go the opposite side, as I sort of said with a too slow of a moving average, or if you take into account too much price, then it just turns into a really slow kind of horizontal line. So there has to be that dynamic but holistic elements. Those two concepts are really important for volume weighted average price because that's what it does differently. Okay. So we've got our variable to know if the stock is strong or weak, right? Then we really are looking at, when you think about this, and this is another, golden nugget of this speech, so please, if you only hear a couple things, hear this as well. What we're calculating is the whole market's win or lose delineator. So it's like we took a vote, and we said, how do you feel about the market at this price? And then at this price, and then at this price, and what about this price? And then based on that vote, we calculated sort of how everyone really truly feels. Because again, think about this. We're aggregating where people have committed with their dollars to buy or sell the market. And yes, it is Thinkorswim. I'm sorry. I'm sorry, Doug, if I'm making you snooze, buddy. Remember the boo button it's capital B and then a bunch of capital O's, maybe some exclamation marks. So it's important to understand that it's not just a pivot. It's actually a behavioral aspect of the market that we haven't been able to measure otherwise. So this is important because it's not only a piece of technical analysis, hooray, it's another indicator, but it actually gets you to think about the market from a behavioral standpoint. How do most people probably feel about this market? When a market is above volume weighted average price, what that means is it is trading above its moving average, right? Price is leading the moving average. So it is a bullish setup. Now we'll get into the nuance of how you can detect when it's a choppy market versus a trending market. So don't get me wrong. It's not quite that simple that you buy above volume weighted average price and sell below it. That does not always work. That works in range expansion based or continuation trending markets, impulse markets, however you want to think about them. When a market is chop, of course, it's going to be very hard to get trade initiations off of volume weighted average price as like a pivot or dynamic support or resistance. And that's because it's more of an oscillation point. And we're starting to see that on the cues here today. You'll notice that after bouncing several times, and here, let me make this a little bigger, I apologize. After popping several times, I'm going to draw in a couple notations, even with a little bit of overthrow there. We actually held quite nicely several times throughout the early morning session. Now we've transferred below it. We're not just immediately breaking down. My inclination for this is now we've had our time above volume weighted average price. We'll probably spend a little bit of time below volume weighted average price. All in all, this market is really just oscillating. This is a chop market, and that is a really poor zigzag. I apologize. Really, what I'm trying to say is that if the volume weighted average price, and here you go for everyone who's like complaining, give me setups, give me technicals, right? When the VWAP is moving sideways, that tells you that buyers and sellers are evenly matched. The participation algorithm that tells you average price is telling you that the average price isn't changing. From a behavioral standpoint, do you want to be in a stock that really isn't going anywhere? No. Now you can play reversion to the mean trades. You can play counter trend a little bit. If you can detect that about the market, and 8Ball brought up a great point earlier. He said, it's a challenge to determine what kind of market you're in, and it's a measure of how fast you can detect that. That tells you something about the quality of your trading, really. If you're quick and you're decisive and nimble and disciplined and you're a risk manager, you're going to be fine. So that's why I'm sorry, I really wanted to walk through, like I said, sort of the background in VWAP, why this really matters. And remember, we're talking about sharks here. So as traders win, so let's say this market, broke significantly higher and all the buyers just continued to win, they're more likely to press their bets. This is Newton's first law of motion, right? That's inertia, right? Stocks in motion are likely to stay in motion. And stocks in chop are going to require a decisive, declarative move to break out. So what I'm getting at is this is a very powerful behavioral feedback loop. And this is what I'm arguing is the defining modern market mechanic. Getting alliterative there, right? See, as traders win, like I said, they're more likely to hold on winners. That's that powerful feedback loop. And I'm sure we've all experienced this. That's what I'm saying about unidirectional markets, markets that go straight down. And yes, this is intraday. I'm sorry I didn't clarify that before, Amit. This is what I'm looking at now is the Qs, so the triple Q, on a 1 day, 1 minute chart. And I've got it here without volume weighted average price on the left, and then here with volume weighted average price on the right. Just so you can see what a market with no analysis would look like and where you might be tempted to buy or sell. And of course, you've got your own strategy. Maybe it works, maybe it doesn't. Maybe it includes Fibonacci's, maybe it doesn't. That's up to you to determine what to include. But the reason for me being such a friggin' zealot about this, like I said, is it's different than any other indicator I've ever seen in that because there is that feedback loop attached to it, it's not just the self-fulfilling prophecy that people ascribe to Fibonacci levels. It's much more than that. There's actual order flow elements attached to this. So, okay, last little bit. I want you guys to pretend you're a shark again, okay? Fins back on. Sometimes your clients give you specifics, like sell 100 of these at 85, right? They give you specifics. Sometimes they give you discretion. They say sell 100 at best price available, got to get out by end of day. So there's time constraints, but they know that you might be capable of getting them price improvement, and they're willing to leave it to your discretion. If you fill an order favorably, meaning you get a better price, meaning you buy below volume weighted average price, or you sell for them above volume weighted average price, you're going to earn extra commission, or maybe in the form of more orders in the future from that client, right? Maybe that's how you make your money, but you'll develop a reputation for saving your clients a few cents, which on thousands of shares, of course, adds up to significant money. Now, it's not a discretionary game. Think about this just about getting, let's say, back to the volume weighted average price from above, instead of chasing a stock as it runs up to highs. As long as you're willing to take the risk of not being able to fill for that client, you'll wait to see if you can get a chance at buying at what is the de facto safe market space. It's this volume weighted average price. We know mathematically, like categorically, there's going to be a ton of liquidity there, because if you asked all the people in the market where they voted with their dollars, on average, that's going to be the highest ranking price level. What does that tell you? That the most number of shares were effectively transacted at that level. So that's obviously going to be an important price mechanic for you. Okay, so let's say, go back, you fill an order favorably, it goes well, right? Then it clicks for you. You're not dealing with prices, you're dealing with levels of participation, right? So you have to use this VWAP to understand where the client is going to judge his fill on that order relative to. This begins that crazy benchmarking process where your clients are gauging the quality of fills and you're gauging the fill. And really all you care about is getting VWAP or better. VWAP or better. It doesn't matter if you're buying or you're selling. So if you separate the market into 50-50, where's the overlap? It's the people who want to trade at VWAP itself. It's the people who don't care about price improvement. They just want to get the order on at VWAP so they can take it off their books, not worry about it for their client. They got them out safely, cool, whatever. So here we go. Another golden nugget. Consider this. What we're identifying in this, major aggregate win or lose point for the market, we're also looking at, I don't know how to say this. I guess it's the one safe place. That is the best way to say it. The one safe place for institutions to transact. Now, of course, we've all seen the end of day when a stock is spiking and it's trading to highs right at the close. That's clearly because somebody had an order they didn't fill. It's 345 and they got to get that sucker on. Their client obviously is going to be a lot less happy about not getting filled relative to just overpaying. They're okay with overpaying a little. They want to get that order on, though. So if you think about it from an institutional standpoint, there are always going to be tons of orders that are pegged to the VWAP, because this is that shark algorithm's, thematic variable. That's the broad, all-encompassing measure of trend that we can apply to any stock, anything with volume. And I mean that, anything with volume. Bonds,